Good morning. Welcome to the XM.com weekly market update. And joining us again is Peter McGuire, the CEO of XM. Good morning, Pete.
Good morning, Andrew.
Great to see you again. All right, we'll get into those numbers. Domestically, the retail sales for Australia came out 0.4 up. If we look at that chart there going back a couple of years now, it's not too bad. I know the numbers aren't huge at the moment. They're sort of hanging in there, but obviously we've got that, I guess, the effective interest rates certainly kicking in.
Absolutely, yeah. But it's better to be in the blue, should we say, than in the yellow. So at the moment, if it can hold even at that sort of line moving forward, depending upon how, and then it comes down to naturally how aggressive the RBA is going to be in the foreseeable future. But yeah, I think it's just the term of what we've got, and we absorb the numbers and appreciate what's going on. Hopefully less people are traveling with the value of the Aussie dollar, and they might be spending on consumables and bits and pieces in retail over the winter.
Yeah, and it's sort of it's like the economy and the consumer is in that transition mode, like adjusting to these higher interest rates. And
sure.
I agree. As long as that's in blue, then you would say that is a positive.
Absolutely, yes. And the dollar isn't attractive to travel overseas at 0.67, my dear friend.
Correct.
For, $48 a cappuccino. Maybe not that much, but you know what I mean.
And that, talking of the dollar, so this is of a chart from yesterday. It was at sort of the high 66s. It's now slightly over 67. So pretty much range bound the last couple of months, though.
Yeah, exactly right. And you've got to be conscious where if you go back to October and where the equity markets were then, and the value of the US dollar, and then all of a sudden it came out of the blocks and it was just daylight to an enormous rally from that late September, early October bottom out up to Christmas, or a little bit further on into January, was just outstanding. But we've said this for a number of months, my dear friend. The Aussie has been dead over that last 4-month window, May, April, March, Feb even. It's done nothing. It hasn't been a trade for traders. There's been so much other easy money to look at, whereas the Aussie's traditionally quite volatile. If you look back in that chart to last year, it was like game on.
Yeah, for sure. And you just see it. It's range bound at the moment. So time will tell how that sort of pans out. Yeah. Moving up into Asia, we had the Chinese CPI number, which is only just above zero, which in some countries they would probably love that at the moment, but being so low is not necessarily a good thing.
No, it's not. And the inflation story I find hard to believe when you're looking at what they previous months were. And really where we are now, I just think, the world's gone crazy on inflation. We've got interest rates at 97% in Argentina. I don't know what their inflation is, must be over 100. But, how come China's not getting a real big lick of it? So, it's interesting to see how it all plays, because they're buying goods, their export, and I heard this the other day. I was on a panel out of the Middle East, and our export numbers for March were our greatest ever for iron ore, going from the Port Hedland export into China. So we're exporting at record levels.
I know, interesting. So
it is interesting.
Yeah. And once again, you look at the manufacturing activity in China as well, like obviously not at the pandemic lows by any mean, but you look at that over the last sort of couple of years, it's sort of in contractory mode to a certain extent.
Yeah, and I agree with you, but my previous statements as far as exports, and they're importing at record levels, where's it going? Is it sitting, they're not eating it. So you've got to they must be storing it somewhere, Andrew.
Well, that's what I was about to say. Are they stockpiling it somewhere? But still, it's it's a lot of
iron ore to look at. I'd hate to see where it. It doesn't age. It lasts for a few. It'll see you and I out. You can put it on a warehouse, but the areas that you must be storing it at must be enormous.
Yeah, well, you would think so. Yeah. Well, time will tell. Maybe we might see these figures start ticking up in the next couple of months. But anyway,
I think so.
Yeah. Over to gold, once again, very strong still, over that $2,000 mark. And as you'd mentioned off camera, plenty of central banks are interested in gold at the moment.
Oh yeah, their appetite hasn't waned, and it's actually increasing. And there's a chart there. You would lay that one over your Aussie dollar, lay it over your US dollar and equities, and it's just been game on since October, really, for gold. A $400 odd, $500 rally to the upside. So yeah, just quite incredible. And I still think, and many of the big banks are tipping. I think JP Morgan came out 2,200, or one of the other big banks, as far as over this year. We're only got 7 months to run, 7.5 months to run today, till Dec 31. You'll see 2,200 broken for gold. So hey, we'll just have to wait and see whether that materializes. But I won't be surprised, Andrew.
Yeah, big numbers, and this chart shows it even more. The way gold's performing, particularly, you look at the dollar index as well. That gap has widened considerably.
Oh yes, absolutely. And when you're seeing what it's costing in yen, or costing in pound, or euro and Aussie. So yeah, I think it's best days, as everyone's saying. It's a safe haven. Its best days are ahead of it, and don't ever forget its little brother, silver. Because I think from a ratio perspective, there's probably more upside in that at $24 or $25 an ounce.
Yeah, for sure. Over to the US, the CPI number came out last week, which obviously everyone looks at. It was just a tad lower, still sticky, but the PPI numbers came out as well. They're quite a bit lower as well. So you probably wouldn't say they've broken the back of it yet, but at least it's trending in the right direction.
Well, yeah, I've got to admit that. Yes, absolutely. And let's just, again, see how we move forward over this Northern Hemisphere summer. I can't stress enough or heavily enough that we've had a continual push down for, I think, the last 5 or 6 months as far as energy, crude oil. Natural gas has been spanked down from, the 10s to down to 2s. So I look at demand picture. Normally the middle of May is the start of the summer driving season for the US. That it's after COVID, that's gone. So now everyone will travel, I would think, internally in the States, so their consumption will pick up. And keep an eye on the strategic petroleum reserves that Biden used, and whether he's got to top that up, and what price he'll have to top it up at. So that's another concern for energy.
Yeah, for sure. And finally, earnings season is just about over, and it hasn't been quite as bad as what everyone had anticipated. The NASDAQ looking a bit pricey there, but once again, a lot of that price is in a very small number of the big tech stocks.
Yeah, exactly right. I mean, so true. It's the behemoths that have carried the torch, and the smaller mid caps they've languished, Andrew.
They certainly have, but I think you look at those big tech ones, and we've talked about this quite a bit. They got knocked down significantly last year, but their profits continued to grow. So do you think, like, last year was a pretty tough year all around, but were they maybe slightly mispriced and there was a bit of catching up to be done? But they've certainly been strong over the last few months.
Well, if you've got to look at the NASDAQ, it was at 16,000, capitulated to 10, and everyone was calling an 8. It's bounced to 12. Let's see where it rolls over the next, this quarter's halfway through, and I'm not looking for any real surprises because you've had your earnings season. I think the next surprises will be in the next quarter. So I'm thinking more June all the way through to the end of September is going to be fascinating, how all of equities play out, and over this summer period in US.
Yeah, and I think also that 6 month period, that it gives a real good chance for those higher interest rates to really work their way through the system, because it does take time for that effect to kick in.
Absolutely. I mean, I'm even talking to people here in my children's age, and they've got, their late 20s, and there's still a lot of people, Andrew, that have got very, very low mortgage rates, and they're coming out of that. It's all you're coming closer to that tunnel of, it's a train coming towards you. But that's just I think the States is very similar. There's people are rolling into higher rates, but there's still a lot that have in that that nice environment of, a couple of points lower.
Yeah, for sure. As you say, it's going to be interesting when those fixed rate loans roll off, to see the true impact. But time will tell. But once again, we'll keep an eye on all this data. So once again, thanks for joining us, Pete.
Thank you, Andrew, and good to see you. And I'll look forward to seeing you next week in the studio, my friend.
Excellent. Good man. Okay, thanks, Pete.
Take care.
And that's the XM.com weekly market update.